Okay, fam. In this video, I'm going to show you the cheat code on how you can retire and generate consistent, safe, passive income on the S&P 500. I'm going to show you guys two specific strategies and one bonus strategy. Let's dive right in. However, before we do, my masterclass webinar has returned yet again, and it is absolutely free. You guys will learn more during this webinar, this 1 hour you spend with me, than you will anywhere else. That's what everybody has said who has joined the webinars previously. The free webinar is this Saturday, October 19th, 11 a.m. Eastern Time, 8 a.m. Pacific Time. My European audience should be able to make it to this webinar because it's at the right time on a Saturday. Guys, there's going to be a Q&A section. I have a huge announcement during this webinar, and I'll be answering your questions and showing you guys how you can become a better trader and showing you the tips and strategies and my secrets to getting into stocks. So I will see you there. You guys can register. The link is in the information box below. Spots are very limited, and once we're filled up, there'll be no more spots available. So you guys got to register now before it's too late. So the S&P 500 ETF is over 30 years old, and it's ever growing. The good thing about trading the S&P or the SPY is really that the fact that it's going up all the time. There's no real downtrend. In fact, there isn't a downtrend because the word trend means continual. There is nowhere in the 30 years history of the SPY that you're going to find any downtrend. You might find some pullbacks that last a couple of weeks, maybe a couple of months, but really the only time the SPY pulled back more than a month is during the 2008 housing crash right after September 11th. And of course, the pandemic. Outside of disasters like that, you might only get a few weeks of pullback and then she runs again. So it's constantly on the move and constantly moving up, which is perfect because when you run my strategies, if you end up getting assigned and getting into the ETF or the SPY and collecting shares, you're just going to be selling covered calls to get assigned again. And then when it dips, you're going to buy the dip again and continually add to your position. Because the SPY is so active and there's so many people that trade it and the volume is so high, then you don't got to worry about the wide bid and ask spread. There's always going to be a lot of open interest and a lot of volume, which is good as an options trader. And if you don't want to think about it as retiring, you could just actively trade the SPY to generate passive income. So I have three strategies. One short-term strategy that is very aggressive and it involves daily trading. And then I have another strategy, which is a lot more passive and allows you to just do whatever you want, enjoy your life, and trade weekly, bi-weekly, or monthly. And then I have a bonus strategy. So if your portfolio is a little smaller, less than $150,000 to $200,000, and you want to trade the SPY to start growing that portfolio, you can also do so. But this retirement video truly is for portfolios of at least $100,000 or $200,000. A lot of retiring individuals already have 100 to 200K or more, and they're looking to invest and looking to find a way to create passive income. Well, this is the video for you. I'm going to show you the cheat codes on the S&P 500 and how you guys can generate safe, consistent passive income with two different strategies. And if your portfolio is smaller, stick around to the end of this video and I'll show you another strategy where you can generate lots of income on a smaller portfolio. So what we have to do first is look at the S&P 500. I'm going to show you the daily chart. So this way you guys can see that there is no downtrend in the S&P 500. Remember, a downtrend is something that's continual. The only time in the S&P that you'll see any downward trend was right here during the housing crash of '08. And then you'll see from the 2020 COVID, you'll see right around here in 2022 until 2023, there's about an 8 to 10 month window. And it really wasn't a downtrend. It pulled back and it consolidated, then it ran again. But other than 2008 and 2022, after the pandemic, if you remove those two events from history, the SPY has consistently gone up. And even after 2022 and 2023, the SPY is consistently going up. That is how the ETF works. That's how the SPY works. NASDAQ, the Dow Jones, S&P 500, the Russell, these ETFs over long term are growth. They get rebalanced every 90 days. And when this happens, only top stocks are added and only top stocks are maintained. Anything that doesn't meet requirements gets removed. So it's an ever growing stock or ETF. So it's not really volatile in the sense where this could drop back down to 400. If the SPY goes to 400 from 579, we have serious problems in the market that we may never recover from. That much of a pullback is almost impossible on the SPY, whereas some stocks could go from 500 to 400. In fact, some of them have done that in recent years. On the SPY, it's different. This is an ETF. And because of the way growth and an ETF works, it's consistently going up. Even if there's some pullbacks, there's lots of opportunity here in the SPY, just like there is when it's going up. But we're never going to have to worry about seeing the SPY pull some crazy thing like this where it just drops. I mean, that would be pretty bad. That would never happen. Unless, of course, the whole economy crashed to nothing, then maybe. But it's a really safe way to trade and to retire and create and generate passive income. I'm going to show you guys the first trading strategy is a little more aggressive. It's trading the SPY daily. And a good way to do this is to figure out what's going on with the SPY each day, intraday. Well, we can do that by looking at the 10-day and 20-day average. The 10-day is above the 20 and we have resistance here and we're above the 100-day, which means SPY is most likely going to open up tomorrow morning and maybe dip a little bit and then run or just straight run. But we also have resistance at 580. So what we're going to do is we're going to look at the 15-minute candle, and you're going to want to do this in the morning between the hours of 7 a.m. and 9 a.m. right before the market opens. You want to look at where the lowest price point of SPY was and where the highest price point was. So for example, we're going to go back to Friday and we're going to see that between 7 a.m., which is right here, we're actually going to go into the 5-minute candle, and we're going to see that between 7 a.m., which is right here when it opened, we have a bottom of 575.73. Right before the markets opened, our peak would have been 577. So what we do is we know that our pre-market bottom was 575.73 and our pre-market high was 577.01. When the market opens, we're going to wait to see what happens. Because this candle broke above the morning high and then it pulled back, we now see a massive pullback here all the way to the halfway point. We're still going to wait. Once we see these candles coming up and we break beyond 577, we're now going to sell intraday puts below the pre-market low. So the pre-market low, 575.73. The pre-market high was 577. The moment the market opens and the stock moves, if it moves above 577 and we see a candle close above 577, we now sell a put below the opening market low of 575. This is a very strong way to generate good premiums. It's $2 out of the money. Each put is going to be worth about $70 to $100 when you're $2 out of the money. So in this specific example, if you had a $200,000 account, you could sell 4 of these puts and this would generate you about $350 a day, roughly $300 to $400 a day. And that means if SPY comes up here and starts to pull back, it's got to fall below the morning low of 575. Now, historically, looking at the chart, anytime the SPY has broken above the pre-market early hours morning high, it's never been able to pull back and drop below the early hours pre-market low. Very few times ever that's happened. And I'll show you guys on Thursday, if we look at Thursday here, the high was 577 and the low is 574. And when the market opened, it ran back up and it could not break the 577 high. And when it came down, it had trouble breaking the morning low. It dropped to 574 though. And it did this right before the market closed, but this is consolidating. So what have I showed you here? Well, I've showed you yet again, the pre-market low was 574.60. The pre-market high was right around 577.47. Well, when the market opened here at 9:30 a.m., it dipped. It could not break the morning low. It ran up, came back down, and it ran all the way up to 577.50, which was the pre-market high, and it could not break it. And because it did not break it and it did not close above it, the rest of the day consolidated and dropped, and it did not break this high until Friday. And anytime it struggles to break the high and starts to drop, it's just not going to break the high. When this happened right here, I sold calls. And as you can see, expired worthless. Just like Friday morning, came up, there was the high, there was the low. It bounced off when the market opened. It came up, came back a little bit, and then it ran. And when it went above 577 right here, I sold puts. They expired worthless. Anytime that you set your puts below the pre-market low and the stock breaks above the pre-market high, it's highly unlikely that it's going to turn around, break back through this support, and then back through this support. Just like these calls printed, because the stock comes up, there's your ceiling, it comes down, consolidates. When the market opens, it tries again. Right there at 12 o'clock, it resisted, and as it did that and pulled back, I sold calls. Now, granted, this is 12 o'clock. You've lost some theta for the day. You could have realistically got into this trade right around here or even here because the 10-day fell below the 20. Now, granted, opening bell was right here. And when we saw this sell-off happening and then it came up, this would have been a good spot to enter, but it pulled back a bit more and then it started to run. This was the key point. When we see this red candle and this red candle, we would get in. Now, even though the stock price did this at 12 o'clock, we would sell a 578, which is only $1 above where this stock price is right now, not even. So even though it's halfway to the day, just about, this would still be worth about $100, $120 intraday. So even at $100, 3 of these would have been $300 more a day. So now we would sell these calls. But if you don't own the ETF, then you obviously can't sell the calls because you don't have the ETF. And I would not recommend selling naked calls. This is not good. So don't do that. What you in turn would do, instead of worrying about selling the covered calls, is you would sell call credit spreads or you would buy puts. And what I would do is when I see this resistance happening right here, I would then buy puts because obviously it could not break 577. It's only going to end up going down. And if you had done that, this would have printed you a 30% return in a day. The call credit spreads are probably a little bit safer in my opinion, because once this resistance happens and you're seeing the second candle and it starts to drop, you could do a call credit spread. And if we did an intraday call credit spread, $1 above, that'd be doing like a 581. We would sell this 581 and then we would buy, or actually we could even buy the 586. It's perfect. There we go. So we'd make $56, but it would be only a $500 collateral. So since we're not putting up $50,000 to sell a put because it's likely the market's going to drop or the SPY is going to drop, and we don't want to buy the shares and sell the covered calls, we could go ahead and run this credit spread. We could run 10 of these, which would be 560, and we're only putting up $4,000 of collateral. So if you want to be a little bit more edgy and you want to run 20 of these, you can generate $1,000 a day. Realistically, on a $100,000 account, putting up $10,000 a day, you could safely generate a lot of money. However, if we're going to do that, we would do this a lot safer. In this specific example, when it hit a peak of 577, I would go up, as it's dropping, I would go up to 579. There's no way the stock would be able to run $2 after 12 noon. You only have 3.5, 4 hours to make this run, and it's already resisted 577. So what we would do is we'd go back and we would in turn, instead of, doing $2 out of the money or $1 out of the money, we would be doing almost $3 out of the money. In this case, we would be selling a 582. So 582, we would buy a 587, $310 for 10 contracts. If we're going to run one, it's $31, very safe. The delta here is a 20, which is highly unlikely that SPY is going to jump $3 in a day. It could, if you want to be a little safer, you could go a little higher, but we already saw it's now noon and the stock has resisted 577. So we go up to 579, $2 out of the money. This right here is a little more than $2 out of the money. So you probably get a little bit more. This is $2.50 out of the money, or $2.55. And so this would be similar to a 579 at noon on Monday morning, but we would lose a little bit of theta. And what would likely be the case is this would be worth about $20, maybe 25. So if we were to go ahead and set this to 25, because remember, you're going to lose theta during the day on these contracts because this is an expiring daily contract, it's a daily call option. And so theta is going to be rough. So at noon, even though we're only $2 out of the money, this is going to be worth about 25, maybe even 21 or 20. So even if we go low side, $20, we put up 10 of these on a $100,000 portfolio. This is only $5,000. You're still going to make $200 and it's very safe. So let's go ahead and say 20 days times 200. That's still $4,000 a month times 12 months. You're still generating about $50,000 a year, which is a 50% return per year. And you're doing this on only $5,000. If you decide to ramp up your game and do 25 and then put up 12 grand because you have $100,000 or $200,000, then you make $500 a day. And $500 a day times 20 is $10,000 a month. And that is $120,000 a year. So essentially it's 100% return, 120% return per year. Now, you're not always going to get these call credit spreads. You're only going to do it when the S&P 500 peaks against its morning high and drops below, like I showed you. You'll only do call credit spreads when you see this. Morning high, it drops, bell opens, it resists, and it starts to fall. Then you go above $1 or $2, preferably $2 for a 20 delta, 15 to 20 delta, and you sell call credit spread. Then you're good to go. If the call credit spread works against you, which, sometimes it'll do that. And you're going to want to make sure that when this looks like it's going against you, that you're going to tick off right here where your 579 call credit spread is. And your break even is going to be about $60 above that because you're getting $60. So it's going to be 579.60. And then I change the color, or maybe a little higher. So you're going to be getting about $30 per contract, maybe 20. So you're going to come up here, and this is where your break even is going to be. I'll change that to maybe like peachy color or something. No, it's a little dark. There we go. So that's your break even. If the stock or the S&P 500 was to have come up this way after you've sold it, as long as it stays in between, you're still good because you're still below your break even. So that wouldn't matter. So you got to watch it. It's not a weekly contract. It's a daily contract. So it's only a couple of hours of watching it. And for SPY to make this kind of a move in 3 hours after it resisted would be highly unlikely. So that moves us along to the put strategy. Now, this is the one that I teach my students a lot in the Discord. This is really what I teach all of my retirement students. I have students that have $200,000 accounts that are making $12,000 to $15,000 a month consistently for the past 3.5 to 4 months. I also have other students that are running this exact strategy on $50,000, and they are consistently making anywhere from $2,000 to $5,000 a month. And over the last 3 to 4 months, they have also generated anywhere from $10,000 to $20,000 in profits or more. Very passive and consistent income, but it depends on your portfolio size. If you guys are interested in learning even more than what's in this video and you want to join the full one-on-one coaching, Discord, and training, and join my masterclass bootcamp for retirement, and we dive into this even deeper and we spend hours over the course of 6 weeks studying just retirement strategies, I would love to help you guys out. You can sign up investwithcorey.com. Links in the information box below. You can see it right there on the screen. Once you get to the website, you can click on case studies and you can see what all my students are talking about and how they're generating profits and consistent income. Everybody in the Discord is making 10 to 15% their first and second month. You're going to click on training, and then you're going to watch this video and sign up and book a call with me and my team so that we can help you with a perfect plan that fits your situation and your strategy and needs. And I don't have time to explain everything in this video, which is why I'm telling you to watch this on your own time. You guys can check out this video and then go ahead and book a call. I look forward to helping you guys out and grow your portfolio. So we get back into the SPY, and when we see something like this previous Friday, we got a morning low of 575. The stock goes up pre-market 577. It dips down and then it comes up, and we see it breaks right at 10 a.m. It breaks above and closes above 577. So we're going to go ahead and sell a 575 put, which is down here, or we could sell a 576 put. I probably would sell the 576 because it's more aggressive. If we get assigned, then the stock runs and we're just going to get out at a profit anyway. So we'll sell the 576. At this time, it's $1 to $2 below the money. So it would be the equivalent of selling a put right now at 578, $1.25 below. So we would sell a put at 578. Which would give us a premium of $97, but then we're going to lose theta for the first 30 minutes of the day, which is not much. Volatility could also change that, but we're looking about $97. You might get filled closer to 100, but I would say realistically 97 or 98 will be what you get filled at around 10 a.m. And if you run a $100,000 account, maybe you could run 2 of these contracts. It's $196 a day. And granted, on a $100,000 account, $200 a day times 20 is $4,000 a month times 12. Realistically, it's about $50,000 a year, but you're probably going to make more than that because sometimes you're going to get assigned. And when you get assigned at 578, the stock will dip to 575, 576, whatever. And then a week later, it runs to 580, 585. You sell some covered calls, make premium, and you get out with like a $400, $500, $600 profit times 2, which is $1,200. So most times you get assigned, it takes a week or 2 to play that out. But then you got to divide, if that was to happen and the stock was to go to say 584, that's $1,200 profit plus maybe $200 in covered calls plus you had the $200 in the put. So it takes 2 weeks to play out, which is 10 days. You divide this by 10, you're still making $160 a day. So on a $100,000 account, this might happen multiple times a year. So you can't say, well, what do I do if the stock pulls back to 578 and I get assigned? That's okay, because it might take a week for the stock to run back to 580, 582, sell covered calls, and then get assigned and exit with a profit. But by the time that happens and you divide that profit by 10 or 20 days, you're still back to $150 to $200 a day. So on a $100,000 account, the average profits are $200 a day. Sometimes they're a little bit more. And if you have a $100,000 account, what I personally would do is sell one put for $100, and then I would drop down to say a 576, which is $2 lower, and I would sell a put credit spread, $500 spread, and I would run maybe 10 of these. So you're putting up $5,000 to make $380. So this day is really $480. So on a $100,000 account, you could make about $50,000 a year. So that's about 50% return. If you supplement maybe a couple of times a week or a couple of times a month, when you really see something like this, I know for a fact they're going to print. This might happen like 3 or 4 times a month, and you can make, $380 multiple times a month. So let's look at the calculator, and let's say you did 4 times a month, you did $380. And then $200 for the put that you sold both those times. And then you have another 16 days where you're just making $200 a day. That's $5,000 a month times 12 months. On a $100,000 account, you made $60,000 in a year. That's 60%. This is a lot of premium. And that's if you only do 10 contracts. Remember, if you have a $100,000 account, you sell one put, you have $50,000. If you're running 10 contracts, this is only $4,000. This is only 10% of your portfolio. It's safe. If you'd like to go a little bit more aggressive and sell 20 and do this a couple of times a month when you feel that your due diligence is paid off and you have confluence in where the stock's not going to go, in this specific instance right here, we've seen the stock goes above and closes above the morning high. So we sell puts below the morning low, which is 576 right here. So we're going to do that. We just go down to 576, but we're going to be safer. So in this instance where we see the stock breaks and closes above the pre-market high, we sell the puts below the pre-market low, or right at the pre-market low of 576, but we'll be safer and we're going to go down to 575. This is really far out of the money. This is $4 out of the money. You see the stock price up here is 577 and change, and we're coming down here to 575, which is $2 out of the money at this point, almost 3. So we can come back here and do a 576. Which is where we're at right now. And you can see that would generate on one contract $38. It's very safe. This is a 20 delta. It's probably more like an 18 delta by the time the stock's moving with volatility. So we're at an 18 delta and we sell 25 of these. Sure, it's 11,000, but you have 50,000 to play with at this particular point, plus the 50,000 you have in the put. So this gives us 950 for the day. And you can also take profits. If the stock starts going up like it does here, by the time it reaches 578, 579, we're looking at 11 a.m., you probably take 60% profits. So at this point, you're not even halfway through the day and you've already made $500 and you can get out, not take any chances. So this might happen twice a month, 3 times a month, and the rest of the time you're just going to sell puts, and sometimes you might get assigned, the stock dips, then it runs and you get out. But at the end of the year, by the time you average that on a 12-month basis on a $100,000 account, you can make between $40,000 and $80,000 quite easily. So I would say 50 to 80% return per year. On a $200,000 account, same thing, 50 to 80%. You can make about $100,000 to $150,000 a year on $200,000 if you're running this strategy. Now, this is a very aggressive strategy. You might be saying, okay, Corey, do you teach all your Discord students only the aggressive strategy? Well, no, I don't only teach the daily trading on the SPY. I mean, me personally, I trade the SPY once in a while. I don't trade it every day, and I definitely don't trade it every week. Some weeks I do trade it, and then there are some months I'll do month-out contracts on the SPY. And then a couple of times a year, I get really aggressive, and for a whole month, I'll trade the SPY daily. I've always done well with the SPY. The last 6 months, I've been more heavily involved in Palantir, but this strategy built me a really solid foundation over the years, and I've generated probably close to $1 million over the past 3.5 years on the SPY alone. Pretty close, like 700,000-800,000. Tesla and Palantir have maybe a lot of money as well. So if you guys don't want to go to the trouble of doing this charting every morning and doing daily options, what you can do is you're going to look at the average prices of the S&P. You're going to go to the 1 hour chart and it's going to clean things up. And you're going to look at the chart just like this. Let me get rid of these lines and this line down here. What you're going to do is you're going to find a foundation of support for the SPY. We're opening up this week, so it's a perfect example. We're looking at the SPY right now. The bottom is 574. So what we're going to want to do is sell 574 puts. And we're going to want to wait for the S&P to drop. And because the 10 is above the 20 and they're both above the 100, we might get a morning dip. But if it does happen, it's going to dip to 577.80. Maybe. It might drop $1 or $1.50 possibly in the morning. But we have to also look at Apple, Google, Tesla, other stocks that are in the S&P, Palantir, and see how they're doing. Keep an eye on those. And we're going to want to watch. If this stock just starts shooting up immediately, we're going to go ahead and immediately sell the put. If it's pulling back, we'll get more premium, and then we're going to sell the put. If you want to be safer, you go below the 100-day average, which is 574 because it's 574.24. If you want to go just a little bit safer, then we'll go down to 573. We'll come down to 573 for the week. Personally, I would sell the 574. I just would, but it's up to you. Let's go look at the weekly options for the 18th, selling a put for 574. It's $187. Now, this is a delta of 28. It's weekly, so it's fairly safe. This is 167. I would do the 574 because it's right at our foundational support. I'll sell the 574. And if you have a $100,000 account, you could sell 2 of these, and this will generate you $374. And we're going to divide this by 5 days. So $374 divided by 5 days. You can see that this is only $74 a day. So this is only going to generate about $1,500 a month, which is about 20 grand a year. So on a $100,000 account, this is only a 20% per year return, which is a little bit on the lower side. So in order to combat that on a smaller account, less than $200,000, what we will do is we will sell one put and then we will drop to 570 down here. And then we will buy 560, which is a $1,000 spread. This gives us $74 for the week on $1,000. We can click continue. We could run 10 of these contracts. It's only $10,000 and we make $740. We divide 740 by 5 and we're making $150 a day. So we're going to add the $170 we get from that put, one put per week. Then we're going to add the 740 right here. 910 per week divided by 5, 182 a day. Again, we're still making a very healthy 50% per year trading weekly. Now, you might be thinking to yourself, Corey, what is the risk factors? Well, the risk factors on a put credit spread, if you know how to manage a trade, are a little bit lower than one would think. And because we went to 570, let's look at the chart. What are the chances of SPY dropping all the way down here in 1 week? So Friday is right here. In this amount of time, is the SPY going to drop all the way down here? I mean, it's possible, but very unlikely. So what we're going to do with this strategy is we sell one cash secured put. Our put credit spreads are always going to be at a very safe delta. As you can see, this delta is 18. Anything below 20 is highly unlikely of happening, and anything below 15 is like you're basically almost not guaranteed money, but very close as it's going to get. And if you need to play it a little bit safer, and even let's say we're going to go down to 565 and buy the 555 on 10 contracts, we're going to put up 10 grand to make 400. Well, that's still almost $100 a day. And what one could say, and one could argue, free money. So if you're going to run the strategy the first way I showed you daily, and you want to watch the pre-market and say the pre-market is 565 and the highest is 569. If it breaks above the pre-market high, you sell puts below the pre-market low or put credit spreads. If it breaks below the pre-market low, you sell call credit spreads or covered calls above the pre-market high. If you're doing the weekly, bi-weekly, or monthly, you can do it just like I showed you here with the 10-day, 20-day, and the 100-day, and watching the RSI and understanding price action and being very safe and realizing that the ETF is not going to go below 574 this week. And if it's not going to do that, it's definitely not going to break below 570. So we sell a put at 573. We sell put credit spread at 570 and a couple more at 565. And we're going to generate about $1,500 to $2,000 a week. This is very consistent. And by the way, that $1,500 to $2,000 a week is on a $100,000 account. On a $200,000 or a $300,000 account, realistically, we'll be generating somewhere in the neighborhood of around $3,000 a week, maybe a little bit more. Like I said, I have a student named Josh, he's generated insane money. He has consistently made like $15,000 to $16,000 a week on his $300,000 account. So if you have a $100,000 account, you can see right there, you'd be making about $5,000 a week just based off of him. If we're basing it off of Josh or we're basing it off of my other students in the Discord that are relatively making the same money, like Thomas or Chris, they are pretty much doing on $300,000, $400,000 accounts, they're making $15,000, $16,000 a week. So that pretty much means on 100K, you could make 5K a week. You could. That's a lot, but you could. I say realistically between 1 to 2, which is why if you're wondering on the options that I just showed you on a $100,000 account, I showed you how you can generate $1,000 to $1,500 a week. That is a very safe and extremely reserved and modest income. On 100K, you could make $3,000, $4,000 a week. You just have to do your due diligence and understand there's more to this than, just watching these lines or watching the price action. There's a lot that goes into it, and I do teach that in my Discord and my coaching. Now, if you have a portfolio that is unfortunately a lot less than 100,000, let's say you only have a $25,000 portfolio. I have students in my Discord that have run this strategy, dozens of them in my Discord right now, that have started with $10,000 and they've turned it into 25K in 4 months. Others that have started with 8K turned it into 18K in 2 months. I have a few students as well that have $25,000 portfolios and turned it into 50K in 2 months. So you can do this with a small portfolio. What you're going to do is run the same strategies I just showed you, but run only call credit spreads and only put credit spreads. And you can also buy a leap option. And this works for large portfolios as well. If you have a smaller portfolio, then you'd want to go out. You wouldn't want to sell $25,000 in a week. If you only had 20,000, you'd want to do no more than a third. So you'd want to run maybe 10 contracts. It's 10K, probably a little bit less. You'd run 8K. So if you had a $20,000 account, you run 8K, it would bring you about $320 a week. Now, that doesn't sound like a lot, $1,200 a month, but you're trading on a $20,000 account and you're making $1,200, maybe $1,500 a month. That right there is pretty big. That's a lot. That's almost 10% per month. Now, that's also very reserved at 555. So realistically, let's say you have a smaller account, you want to go more aggressive. Let's say you have $25,000. Then what you would do is we would sell something weekly. We would go weekly at maybe 570, 572. And I'd say 570 because I really want to be safe. A 570 going out in the week is 18 delta. We'll click on that and then we'll buy the 560. So this is going to generate you $74 on every contract. Let's say we run 8. This is going to bring you almost $600 a week. $600 a week, you could probably go a little higher. Let's go for 10. Remember, you have a $25,000 account. You're putting up 10K. It's only about 35-40% of your portfolio. It's a little risky, but when you're trying to grow these smaller accounts, sometimes you got to run these types of strategies. So this is about a $750 per week, and we times $750 per week by 4, $3,000 a month. You only have a $25,000 account, so this is like an 11 to 12% per month return. If you do this by 12 months of the year, you just more than double. So in less than a year, you'll have close to $40,000. Now, granted, you're not utilizing all your money like some of my students have done from time to time. You can be a little bit more aggressive. This is also a 570. You could also do a 572 because let's face it, even a 572 is only a 23 delta. It's very, very safe. This will generate you about $4,000 a month on a $20,000 portfolio. Do you see how this is like really lucrative? You have a $25,000 portfolio and you're only putting up 10 grand of it, and you're going to make $4,000 a month. So in 3 months, that's $12,000. So 50% return over 3 months, that's 16% per month. That's 4% per week. That's very good. You have a $25,000 portfolio and you're going to generate in 6 months, let's say 24 grand. You double your money in 6 months. So now you have 50,000 in 6 months, and now you can run double this in the second half of the year. You could run 20 because now it's 20,000 because you now have a $50,000 portfolio. So now you're still under the 50%. You're more like 25, 35% of your portfolio. You doubled your portfolio. So now you're doubling from 10 to 20 contracts. Now you're making 8,000 a month. So you can make 8,000 a month times 6 months, 48,000 profit plus 50,000. So you can see here how you went from 25 to 100K in a year. It's a 4x return in a year. Realistically, 50% to 100, 2x is very consistent and I would say more than half of my students achieve 3 to 4x. So I would say safely 50% to 100%, which is 2x. You can aim for 2x, 25K to 50K in a year, but a big chunk of my students are doing 3 and 4x. So you could turn 25,000 into 50,000, and we're not even utilizing all of the cash. If you were to utilize most of the cash, remember, you have a $50,000 account, you've doubled it in 6 months. This is only 36,000. So it's like 60, 70% of your portfolio, but you're generating $4,000 a week. If you do your due diligence with RSI and the charts, you can do this. I've done it consistently. My students do it consistently, but I recommend doing the credit spreads, whether put or call, below 20 delta, and you will consistently win. So what happens if you are in the negative? What happens if the stock starts dropping? Well, if the stock does this number and you get into a put credit spread right here, stock comes up, resists, it starts to come down Monday and Tuesday, well, that put credit spread is going to be in the negative. But you got to remember, if the stock stays above 570, you're not going to lose any money. You're going to keep all of that premium. Even if it comes down to 571.90 right there, it's going to show you're in the negative because of theta decay. But if the stock stays relatively here, you'll notice that Tuesday and Wednesday and Thursday, now you're in the green again. You'll go from negative to green because theta is killing it. It has to go below on Friday. It has to be below this line on Friday, plus your break even, which is about $38 a contract, so 38 cents. It's actually got to go to 569.70 or 569.68, which is down here. So it has to go below that green line even for you even lose even a dime. So if it drops on Monday and Tuesday, see right here's Tuesday, right at the end of the day, it's down here. You're thinking, oh my God, you know, I'm in the negative, like, I don't know, I'm in the negative $4,000, $3,000. You're not. It might show like a 10% below. So it's hard to explain because right here, I can't actually show it to you because it doesn't simulate a loss. But I can show you another contract I've got on Rivian. Same exact thing because it's a put. You'll see I'm in the negative on Rivian, right? Okay, I'm in the negative because it's $12 put or $11.50 put. It's a $12 put. So it's a $12 put, and you can see that I'm in the negative because the stock price is $10.44. So I'm $260 in the negative. Same as a put credit spread, it's going to read very similar. Except if we go forward in time to this Friday, even if the stock stays at the same price, it's $240 in the negative, and right now we're $260. So I'm $20 more in the positive, even though the stock didn't do anything. That's theta. And so it's the same thing. If the stock drops and consolidates, don't worry, because we just got to make it to Friday with the stock right here. It'll decay worthless, and you get to keep all that premium. And this is something you have to have subconsciously, built and driven into you. So this way you understand what's actually going on. In the event the stock continues to drop and drops below, you have to see if this stock consolidates. If it drops and consolidates and you see there's a lot of consolidation on Thursday and it's consolidating, wait till Friday, because then it's going to start working its way back up and then you're good to go. If it doesn't, close it midday for a small loss, because somewhere around here, you're only going to lose about maybe $10 a contract. Even if it's midday, maybe 20 a contract. So you're actually going to possibly take partial profit. You're most likely going to be somewhere between, I don't know, 0 and a small profit, just depending on how things go. But you're not going to lose all of your capital because it's so close to expiration and you're so close to your strike. So that wouldn't be a concern. If it happens earlier in the week where it starts to drop really low, I honestly, there's no point even talking about that. Forget it. We're not even going to talk about it because the chances of SPY dropping $9 in one day outside of some catastrophe or something like that happened back in August or the elections, it's unlikely. Like if we're sitting here right now, everything's the same, bar the election. The chances of, let's say, this happening this December or January, it just dropping to 570 in one day, probably not happening. Probably not happening in 2 days, maybe in 3 or 4, but you'll see that progression in 3 or 4, but theta will eat it up. And even in 3 or 4 days, as the stock drops over here, you're still going to get out at a very minimal loss or even some profit then. So this is a very safe strategy, which is why we do it like this. This is why I operate like I do. So you guys can see that retiring on $50,000 or $100,000 or even $200,000 is very doable. If you have a $100,000 account, you can generate $40,000 to $80,000 a year or more. If you have a $200,000 or $300,000 account, I have students that are already doing this. They're generating $100K in 3 or 4 months. And you guys can do this as well. The safe way to do this is the way I have set these trades up and the way I teach my students. This is how you consistently make profits and you do it safely. Consistency is the key. If you have a smaller portfolio, I showed you guys how on 25K, you can go from 25 to 50 in 6 months, 50 to 75, or even 100 in another 6 months. You can at least 3 or 4x your money in a year to a year and a half if you do these strategies right. So with these strategies, you can take even a small portfolio of 25K and turn it into 100K in a year or a year and a half. And then you can start your retirement strategy. And within a year or two after that, have 200 or 300K. This is the 1 to 4 year plan, really, or the 1 to 5 year. I really like to say it's the 1 to 3 year, and then the 3 to 5 is even safer. But if you guys are interested, so ultimately you guys can see that this is my 1 to 3 and 3 to 5 year plan in 2 stages. Even on a small portfolio, you can print ridiculous, consistent, safe profits. And that's what I like to teach my students, is how you can print money consistently and safely so you can retire early and live your best life and do the things that you want to do. Don't forget, guys, free webinar this Friday. Don't forget, guys, free webinar this Saturday, October 19th, 11 a.m. Eastern Time, 8 a.m. Pacific Time. I'm going to be hosting a Q&A after the webinar and a huge announcement during the webinar as well. You guys will learn more in this 1 hour with me than you will anywhere else. That's what everybody who has been saying that has joined in on these webinars in the past. I look forward to seeing you guys there. If you guys want to also sign up for the coaching, Discord, and the training course, if you guys just want to jump right in and dive in with me, I would love to help you grow your wealth and retire early. You guys can sign up, investwithcorey.com. Links in the information box below as well. And you guys can sign up at any time. I look forward to helping you guys grow your portfolio.